Imagine you are living in the year 2072 and someone mentions the NVIDIA crash. They are not talking about a simple red candle on a chart. They are talking about the moment an entire story snapped, a period where expectations, infrastructure, geopolitics, and technology all collided and forced the market to breathe. It was not a freak accident, not a sudden meteorite, but a slow, uncomfortable reset. NVIDIA was standing at a historic high, and at the edge of a correction that a few people warned about, but almost nobody truly wanted to see. In the end, the crash was less about technology failing and much more about expectations collapsing. To understand how it happened, you have to go back to the early years of the 2040s. At that point, NVIDIA was the face of global AI infrastructure. People talked about it the way they once talked about oil majors or telecom giants in the 20th century. If you needed compute, you bought NVIDIA hardware. If you wanted to train a model, you used CUDA frameworks. If you built a new data center, entire halls were filled with NVIDIA GPUs. The company was bigger than gaming, bigger than software, bigger even than chips. It was a central pillar of what people now call the compute economy. Around the year 2041, NVIDIA's market value reached levels that older investors would once have associated with entire national economies. Analysts were no longer just comparing it to other tech firms, they were comparing it to whole sectors. The company stopped feeling like a stock and started feeling like part of the air. That created a classic psychological trap. More and more people quietly began to believe that the stock could not fall. NVIDIA was no longer seen as a business with risks, but almost as an invincible force of nature. The belief that AI will not stop, and therefore NVIDIA will not stop, became a common refrain among enthusiastic investors. Under the surface, though, the issues that would later drive the crash were already forming. They were not mostly technological. They were systemic. The first pressure came from regulation. Governments around the world started to intervene in compute use, energy consumption, and data center expansion. Europe rolled out strict energy and compute quotas. The United States set up certification bodies and linked access to certain public contracts to efficiency standards. China built its own closed compute ecosystem with domestic chips, domestic tools, and tightly controlled exports. At first, these measures looked like minor speed bumps. Investors told themselves that regulation would never get so strict, that it would kill growth. But rules have a habit of starting slow and then tightening. By the time the world reached the early years of the decade starting in 2040, it was clear that states were not going to simply let the market run unchecked. The second pressure came from competition. NVIDIA had enjoyed something close to a monopoly, not because nobody else could make chips, but because nobody else had the full-stack hardware-software, ecosystem, and mindshare. But by the year 2043, that landscape was changing. New companies were shipping alternative AI accelerators. University labs and open-source consortia were designing low-cost GPU architectures that were less efficient but free from licensing constraints. Photonic chips started to appear in niche workloads, especially in scientific simulation. And the biggest long-term wildcard, quantum computing, began to move from pure research into early commercial pilots. The market became more fragmented. Every new fragment meant a little less automatic dominance for NVIDIA. The third factor was pure psychology. Markets can ignore reality for a long time, but not forever. NVIDIA's valuation was heavily anchored in the idea that AI demand would keep rising in a near linear or even exponential way without pauses. That belief was understandable. Between roughly the mid-2020s and the late 2030s, it really did feel like AI use cases were multiplying without any sign of saturation. But technologies move in waves. They surge, consolidate, stabilize, become infrastructure, and only then do new growth curves emerge. The crash arrived in part because investors were acting as if they were still in the explosive wave, while the underlying market was already shifting into consolidation. The beginning of the crash did not look like a disaster. It looked like a whisper. Around the year 2043, a handful of analysts started to publish cautious reports, warning that valuations had drifted too far. They pointed out that demand for GPUs was still growing, but nowhere near as fast as NVIDIA's share price implied. They highlighted regulatory risk, energy constraints, and rising competition. On social media, they were mocked. People said, "You do not understand AI, and you are stuck in old valuation models." That was the tone. But markets do not care about memes forever. When the first quarterly results landed that showed NVIDIA still growing, but not growing fast enough to justify the most extreme expectations, a hairline crack appeared in the story. The stock dipped a little. Most people shrugged. They called it profit-taking, a healthy correction. But the dip did not fade. It deepened. The correction turned into a trend. The trend turned into a crash. Between the mid and late years of that decade, NVIDIA lost a large chunk of its market value. Not because the company suddenly became unprofitable or irrelevant, but because the story flipped. Investors discovered in real time that even a company at the center of a revolution is not immune to regulation, saturation, alternatives, and infrastructure limits. The media, as usual, swung from euphoria to doom. Headlines shouted about the end of the AI era. Looking back from the year 2072, that sounds almost ridiculous. But in the moment, around the year 2045, it felt very real to a lot of people. That is how panic works. It takes temporary shadows and paints them as permanent monsters. What makes the NVIDIA crash so interesting is not just that it happened, but how the company responded. Most firms in a brutal drawdown go into survival mode. They slash costs, retreat from risky markets, and focus on pleasing investors in the next quarter. NVIDIA did trim and restructure, but it also did something more strategic. It consciously shifted its identity from growth stock to infrastructure provider. Instead of chasing every flashy AI use case, NVIDIA doubled down on sectors where AI could not simply be delayed or canceled because a hype cycle had turned. Healthcare, defense, energy, scientific research. In those domains, the question is not, does this look good in the next earnings call? The question is, does this keep us safe, alive, or competitive over the next decades? NVIDIA started to build long-term, slower-moving relationships around critical workloads that had to keep running no matter what investors felt that month. That shift is what allowed NVIDIA to survive the crash. It lost a whole cohort of shareholders who only wanted fast wins. But it gained something more important: customers who needed guaranteed compute as a strategic asset. The market stopped treating NVIDIA as a shiny tech bet and started filing it mentally next to utilities and core infrastructure. Just as power companies, telecom networks, and transport firms had once become part of national security thinking, NVIDIA, after the crash, became part of compute sovereignty. Governments began to think about water, food, energy, and compute in the same breath. Seen from today, the NVIDIA crash looks like a turning point, rather than a tragedy. For investors, it was a sharp reminder that having the right technology in the right place is not enough if your entry point and expectations are wrong. For governments, it was a wake-up call that regulation, standards, and infrastructure planning were no longer optional side projects. For competitors, it was a window of opportunity to claim niches that NVIDIA had ignored while growth was easy. For ordinary users, it was a reminder that hype cycles for technology can move much faster than the real economy underneath them. From the distance of the year 2072, the crash feels almost necessary. Without that reset, the world might have been far messier. Regulations would probably have arrived later, more chaotically. Alternatives would have had less incentive to mature. Energy infrastructure might have been even more overstretched. And NVIDIA itself could easily have been inflated to a level no company could live up to, setting the stage for a far uglier collapse. The most important part of the story is that it did not end with ruin, but with transformation. NVIDIA went through its hardest chapter since it was founded. It lost value, lost shine, lost a chunk of its myth. But in exchange, it gained something more durable, a clearer role. It stopped being treated as a balloon that had to float higher every quarter and started being treated as a pillar that had to stand for decades. The crash did not prove that AI was a fad or that NVIDIA had failed. It proved that markets had to grow up. It forced everyone to stop pretending that exponential lines last forever. And when the dust settled, NVIDIA was still there. Less glamorous, less hyped, but more embedded, more essential, and more aligned with the world it was actually helping to build.